All right, let's turn now to the Fed. Our next guest says we will still need to see more decisive loosening in the labor market for the Fed to actually start cutting interest rates. So joining me now is Michael Darda, chief economist over at Roth MKM, along with our very own Steve Liesman. You heard the conversation just now between Brian Levitt, Brian Weinstein, with regard to the current state of play vis-a-vis the bond auction that we just got from Rick. Given all that, Steve Liesman, can you give us the setup for what the Fed is going to deal with this week and what kind of commentary we could get, and, of course, what those so-called dot plots are and what they could mean?
So all those are good questions. I think the bond market auction ended up being okay. I see the stocks were relatively unchanged, maybe even a little bit higher on the auction. So it ended up being a non-event. I think we still need to watch carefully, as we've been doing each one of these auctions. I think tomorrow is another event. It's a lot of paper, and the market seemed to digest today's pretty well. As for the Fed tomorrow, or tomorrow and Wednesday, I think that Chair Powell may remind us what the phrase higher for longer means. Because if you stop the phrase higher for longer, it begs the question, higher for longer than what? And higher for longer than we thought they were going to be. But I also think higher for longer than you think they ought to be. I think that's maybe the key way to finish that phrase, Dom. And I think, so the point is when you think the Fed ought to be cutting because you've had a couple rounds of good inflation, I think that you're not then embracing the idea of higher for longer. It is just the time when inflation comes down and starts to behave that the Fed will invoke this idea of higher for longer, because I do think that Powell's major concern is not being the guy who started to cut rates too quickly. I do think cuts are in the cards. I just think the market is ahead of itself here. I believe Powell will remind the market of that on Wednesday.
Michael Darda, it's not an outlier point of view that Steve just points out. There are a lot of folks out there who believe that the market might be a little over its skis with regard to expecting the level and degree of Fed rate cuts next year. Is it true? Is significant? Is it correct in your mind that the markets have declared mission accomplished when it comes to the battle against inflation?
Thanks for having me on, Dom. Steve made a lot of good points. Look, I don't think it makes sense for markets to be expecting rate cuts as soon as they are and as the end of the magnitude that's priced in with the current configuration that we have in terms of the real economy and risk assets. Meaning that if we take a look at where consensus expectations are now, most strategists, economists are looking for a soft landing. Analysts are looking for double-digit earnings growth. Most macro strategists think risk assets are going to continue to rise. And against that foliage, the notion that the Fed's going to drop policy rates 125 basis points, I think, is a bit much to ask for. To Steve's point, I think Powell is once bitten, twice shy. After inflation overshoot for 2.5 years, the last thing that he wants to go down in his record is the guy that started to reverse course and cut rates too early, and then the Fed has to go back and deal with the problem later on. I honestly think he would rather deal with a recession than starting to ease too soon and having to reverse course.
Michael, with that in mind, is there a level that you're looking at for key economic data with regard to what would tell you whether or not things are, all clear is a rough way to look at it. I understand it's not that black and white. It's multiple shades of gray. But what kind of economic data has to come through to make you sense as though the Fed feels a little bit more comfortable about the environment? Is it jobs-related numbers? Is it retail sales? Is it inflation prints? Sentiment data? What exactly then has to be put forth in a portfolio of data for the Fed to be able to now say, yes, let's ease things up a little bit?
Well, I'll give you my perspective and then what I think the Fed is thinking about. So nominal GDP growth has run at double digits on average during this cycle. If growth potential is running around 2%, then you're going to have a big inflation problem. We think we probably finished the year with an average of about 5.5% annualized nominal growth. Next year, we think will be below 4%. So you could actually make the argument that inflation ultimately is headed below the Fed target. Now, why wouldn't the Fed just get out in front of that and start cutting rates? in the back of the Fed's mind, their framework is a slack-based Phillips curve model. So I think they're going to want to have confidence that the labor market is loosening up more than what we've seen, evidence in their framework that demand is weakening relative to supply. And if the unemployment rate continues to move up in a more decisive fashion than it has so far, then by all means, they'll be cutting rates. But, that doesn't really look like a soft landing. It looks like the beginning of a recession in most cases.